And we're live.
What's up?
You partly blew out the audio, but it's okay. It lets me know that when you're hitting a certain pitch, we're there. Who do you think was first? Who do you think was first today?
Um, Someone new or someone old? Because obviously,
Someone new.
um,
Like the usual folks, they haven't been. What's been going on?
was it Keisha? Who was it?
It was Malik.
Malik. What's up?
I know, right? Yo, Jolene, today we have like a dope episode today.
Yes,
Are you ready?
Yes, and hello, we are officially over 40,000 cousins.
Word?
Yes,
Whoa, Jumbo.
Okay. I just saw it. Okay. I mean, just a couple of days ago, it was, I don't know what it was, but it wasn't what it is now.
Hey, we're here now. We are here now, and I'm here for it. Are you here for it?
Yeah, I've been here for it.
Okay. All right. Well, what's up, everybody? I am Mark Monroe, and I am accompanied by my wonderful co-host, co-creator, and co-producer,
Jolene GC in the place to be.
Hey, today was a very, very interesting day. We're going to get into that in a little bit, but we got a huge, huge, huge episode for you because if you see it, it's finals week. It's the end of the first semester of the Come Up series. Can you believe it? We finally reached this point. But if you're new, welcome, Jumbo. We love you. You're awesome. We appreciate your existence. If you've been here for a minute, if you've been here studying and being scholarly and all that other stuff, we see you. Welcome back. Today is going to be a very, very interesting day. If you haven't subscribed yet, and if you're new, then go ahead and hit that subscribe button. I think it's like over there, like down here. Like I don't know, but anyways, go ahead and hit that subscribe button. And of course, if you want to be in the know, so that way you can be like our guy Malik. Shout outs to you. If you want to be with like one of the first people part of the show, then go ahead and hit that bell, so that way you can be a part of the notifications button. I'm so excited that I'm tongue tied. Hit that notification bell, so that way essentially, hey, you're here right along with us. And on top of that, like the video. I mean, if you like us, then great. I mean, it seems like we already got one dislike, so there goes that. But hey, if you hit the dislike button, that's cool. Just go ahead and tell us exactly what is it that we can do to get better. I mean, we always want to make it more popping. So,
Mark, I know what it was.
What?
That was somebody that failed first semester.
Oh, that's
It happens to the best of us. I mean, it ain't never happened to me, but I've heard.
Whew, what a time to be alive. Anyway. Today we got a jam-packed episode for y'all, and honestly, we didn't really need to bring any surprise guests or anything like that. We just brought, the smoke, aka the fire, which is the content, the curriculum. So we hope that you guys are enjoying. We hope that you guys got your pen and paper or your iPad Pros or in pencil, however you do it if you're in this digital world with the rest of us. But before we get into like the awesomeness of today's episode, Jolene, how do we do today?
Oh man, the market, the market was down today. I mean, all across. The Dow was down negative 68.95 points. S&P 500 negative 14.30 points. The NASDAQ was down negative 16.31 points. Then for sector performance, we have energy, real estate, and financials in the top 3 out of the 11 sectors. And then for the bottom 3, we had consumer discretionary, communication services, and tech. Then we kick it over to our pick performance. TSM had earnings today. They also had a 52-week high, so they're also up in the aftermarket too. Research was number 2. WWE was number 3. And okay, calm down. For the last 3, it was Facebook, NVIDIA, and Datadog. Now you can find all of the 31 SIPs on our IG page at That Come Up series. And then for the rest of the, I'll give you your moment to give for the rest of the 31 SIPs. We had some other 52-week highs. Qualcomm was a 52-week high. My stock, babe, SMH, killing it. All chips, no dip. ARKK, killing it. Another 52-week high. And we already talked about TSM and LRCX, which is Lamb Research. So that's all the good vibes. But you know what, Mark? Word on the street. Do you want to know what word on the street is?
I try to keep my ears close to the ground, but hey, let me know what's going on.
Word. First of all, I didn't even turn this on. That's
I
not
was gonna say we need a vibe here. Like, I need to light a candle or something.
Mark, man. I didn't even think it was gonna happen this soon in the year.
What's that?
We got some cousins out here that have been bold. I had to put on a glove. Goon hand is out.
Oh wow.
Goon hand is out, okay? Because first of all, I got receipts on many of y'all who have been playing these weeklies. Weeklies. Now, don't get kicked out the family. Don't do it. And I'm so serious because as we are building wealth and you're going to mess around and jeopardize your great grandchildren's wealth, your great grandchildren's freedom, your freedom for a week, for a thrill. Nah, we don't move like that.
I've seen many relationships destroyed just because somebody went for a thrill.
So if you got weeklies and you're claiming to be a come up cousin, I don't know about that one. We're gonna have to pull your card, put you in time out, have you take a seat, because that is not what we're on. And the fact that, what is today? Today is January 14th. It is January 14th. We haven't even got through first quarter and we already got cousins acting up. That bet not be an OG cuzzo. I'm not going to say no names, but if I keep seeing this, folks will be put on blast. Will be put on blast. Okay. So
are they like trying out for like Wall Street bet YOLOs or something?
Yo, I don't know what they're doing, but whatever they're doing, it ain't right. It's raggedy. Raggedy. We don't do raggedy. So
let's reel it in. So the reason why we actually speak highly against, well, we speak very lowly against or lowly towards playing weekly positions. Wow. Like, I'm so excited about the other part that honestly, I got to like bring it in. Oh, she's taking off the gloves. Okay. So let me get to it. All right. So when we think about it, some of the best traders out there, it's like, they would tell you, it's like, if you got to spend some time in the game in order to get it right to play weeklies. And even then it's like, like that means that essentially that you've taken the time to study technicals, you have a solid understanding on the fundamental side. And then on top of that, you look at the economic factors. So you kind of like operate like pretty much like an institutional trader. I mean, that's what we're trying to teach each and every single one of you to do. Now, of course, I can't control your portfolio and neither can Jolene. I mean, our goal is to help you reach a level to success. So here's just some little like food for thought for you. The next time that you want to go out there and play weeklies, like, or when you want to play a weekly position, or when you want to play anything short term, you got to really look at it in the sense of what's the catalyst that's expected for this position to move. And if you don't know, or if you're just like trying to like earn like a quick dollar, or if you're trying to build some quick liquidity, that is not the way to go, because the only thing that you're doing at this point is you're gambling. Take it from a person in which that first started trading in my college dorm room back in 2004 at Tuskegee University. Yo, that was stressful. Like, just imagine like the type of stress that you just placed upon yourself in playing, say, for example, a weekly position. Now, I don't know if many of you are out here winning or losing, but it's like, I'm probably guessing that essentially if it's coming to our table, and I haven't checked my Instagram or my messages, but I'm probably guessing if it's come to us and if we're being made known of it, then most likely then you're probably not doing so hot. So probably what we should probably just say to you, just in light and in kind, is just maybe that playing weeklies just isn't your speed yet. Now, it doesn't mean that you won't be able to play weeklies later on, but it's like, first learn the game. A lot of folks want to go out there and just like get in the game. And then now you're playing up against the professionals. And then it's like, you realize, why does it hurt so bad? Because you're going up against folks in which that have been in this game forever and they can spot the rookies. So best things first, learn the game, learn how the game is played, then put together a solid strategy, and then come back and then say, okay, hey, once you've had some time and some experience, then you could possibly be there. I mean, even when I play, say for example, a short-term trade, now it's very rare that I play a weekly, very, very rare, because one, I got other things to do, and two, it's like, honestly, I like my time. Um, I would say, like, for me, even there's a certain amount of nervousness because when I walk into any trade, I'm always looking at one, what are the risks, and always thinking that, hey, that this can definitely screw up. And if I'm thinking about that, then it really draws me to pause, not only with the humility, but with the understanding of saying that, okay, maybe this just isn't like the place in which that I should be. Now, shout outs to all of you that are out there winning and everything else. I mean, hey, congratulations. And if you got it right because of the fact that you just happen to be lucky, I mean, still congratulations because of the fact that you built something. But yet at the same token, it's kind of like, well, does that really count as a congratulations because of the fact that you just guessed? Would you rather have a stronger congratulations based upon what you knew versus guessing? I don't know. I'm not you. So, I mean, that's just food for thought. Okay. So,
I'm not gonna spend another moment on it. Like I said what I said, stand by what I say. Don't don't even get in my DMs with weeklies, period.
so shall we go into today's
Yes.
episode? Or do we have anything that we wanted to discuss really quick before I go into it?
Well, first, I didn't ask, how are you doing? That aside, how are you doing?
Good. I'm good. I'm good.
Okay.
I've been in the lab, cooking up some things. I like to say cooking up innovation. So typically that's the code word. If I'm cooking up innovation, then something's on the horizon.
Okay, exciting, exciting. All right. I just have to recalibrate. Off. I'm back to
That's throwing off the whole feng shui here.
then Jolene. I had to like bring it back, but I just saw some stuff and I'm like, oh my gosh, I would be remiss if I didn't say something. So I'm excited for this finals week for what is this, first semester? Y'all, it stays crunk out here for
I was gonna say your block is hot.
Yo, it goes down in downtown Seattle. But yeah, like I'm really excited about what there's, what's happening today because you hinted at it on Tuesday.
I did.
So let's get into it. We also have some questions from some of the cousins as well.
Should I answer those first?
Let me see how many we got.
I mean, I could take 3.
Hold on, I just want to make sure that they're not like the same kind of questions. Hold on.
Okay. Well, while she's going through the questions, I mean, congratulations to each and every single one of you. I mean, to just think about where is it that how far we've come in this process. I mean, even just Jolene and I, and we're of course always figuring out ways in which that we can get better for this episode. I mean, shout out to my grandfather, who's one of like my biggest critics, who also watches the show and probably sometimes sits in this chat. So you never know. But shout outs to him because honestly, without him, I wouldn't be the man that stands in front of each and every single one of you today that can give forth this knowledge. So honestly, it's just knowledge that is passed on. And the ancestor that I would love to thank is my grandfather. So in finals week, I mean, for anybody that understands, and we've all been through some form of schooling, whether it's through middle school, high school, or college, whatever it is, finals week is more so in the sense as a litmus test, but at the end of this finals week, I'll give you something as a reward. But the goal here is just really just to be a review of everything in which that we've gone through over this semester. And what I mean by the semester, the first time that we quote unquote stepped out of the shadows here. And we just wanted to kind of just give you a recap of everything, but also set you on a wonderful course that prepares you for the second semester. So, I mean, grab your pen and paper or your tablets. I mean, and I hope you're ready to rock. So, Jolene, are those questions like, ready for me to fire off on, or should we just pass?
No, we can answer. We can do a couple now and then a couple later.
Your iPhone, by the way.
What'd you say?
I said I like your iPhone, by the way.
Thanks. I dropped it and it has like a little scuff on it, so that kind of makes me sad. Okay, some of these questions will definitely be answered later. A lot of the cousins are hyped about the space ETF that Kathy Wood from ARK Invest is.
Yep.
formulating. So they want to know any thoughts you have on that. Um, Anything you
I
want
can
to?
answer that. So pretty much for those who didn't know, there was an SEC filing from ARK Invest that was letting everybody know that they are opening up another ETF within their portfolio lineup, and it's called ARKX. And ARKX is pretty much space, like everything that's space related, whether it's space travel, space infrastructure, all those wonderful things. Just imagine we once upon a time had NASA, and now all of a sudden we have privatization when it comes to space. Wow, pretty cool. And so what this ETF is going to consist of is companies like Virgin Galactic. I'm probably sure that they're holding space for SpaceX if it ever decides to go public. It'd be interesting if it goes under the umbrella of Tesla. But I mean, pretty much it's been quite requested by folks that are pretty much investors within ARK and outside of ARK. They wanted it, so of course, you got to give the people what they want, and here we are, ARKX. For me personally, I typically am a little cautious when it comes to like picking individual like ETFs within the ARK family when ultimately I could just take ARK with a K because it's a combination of everything and it takes all the good stuff from those other ETFs and then puts it all in one umbrella. But I mean, at the same token, if you want to, go into ARK X, me personally, I think it's going to be good, but I think it's still going to need some time to cook.
Okay. Let's do one other question. Someone asked, is it too late to invest in the stocks that are a part of the 31 SIPs?
No, I mean, it's the market. So it's like the market will always provide you an opening where you can pick your entry point and you'll be able to either invest, either buying it as a stock or picking your opportunity when it's an option. What we typically say is buy low, sell high. And depending on how long you plan on holding the stock, this could be your low. If you're buying it to hold it for a short time, then honestly, maybe this may not be your low. It's just a matter of how is it that you come together and put together your strategy that works best for you. So before you buy anything, have a plan. What is your plan? When is your plan to exit from this position? If you're looking to just buy and hold for a very long time, then honestly, it probably may not matter. And you'll probably just dollar cost average by buying on dips on the same stock. Now, if you're looking to play, say, for example, something a little bit shorter in the investment landscape, maybe like a 2-year leap or calendar leap, then that's a little different. And then at that point, you're going to probably have to be a little bit cautious because we do see companies playing at the top. But I mean, it's kind of interesting because there's always a bull market somewhere and there's always an opportunity just waiting right around the corner.
Okay. And then final question before we get into it. Do you think China will deflate their currency based on their current debt, and will that affect us?
Okay. So I've been holding out on this one for a very long time, and will they do it? I strongly believe that they will. Especially they've already been doing it. I mean, and then on top of that, putting their capital elsewhere. Like for example, I would really like for folks to really start to think about like really who's significantly buying all cryptocurrencies. If you
Okay.
think it's just retail traders or retail investors that are buying up cryptocurrencies, then you're really missing out on really the world that lurks beyond what you just see what's in front of you.
All right. There are some more questions, but we can get those answered later.
All right, now just as a heads up, I'm going to be doing this session because it's finals week. I'm not going to be doing any Instagram or any Clubhouse this evening, so I'm going to say what I'm going to say, and that's it. Consider that the last word.
All right.
All right, is that fair?
Yeah.
Okay.
More than fair.
All right, well, let's get it started. Ladies and gentlemen, welcome to finals week. So when we think about like where we are today in finals week, we have reached the end of the first semester. It's been a long road coming. I mean, who would have thought that even in our wildest dreams that ultimately we would make it here today, having these types of discussions, hearing about folks literally talking about within their own portfolios or saying goodbye to their jobs and saying W2 who would have ever imagined those things? I mean, it's kind of like one of the greatest, storybooks or one of the greatest fairy tales ever written, except that unfortunately this is no fairy tale. It's actually a reality that we're seeing unfold right in front of our eyes. Unfold. All right. So, I mean, today what I wanted to do for each and every single one of you is kind of like give you an idea and like give you a full on recap of this entire semester of where we've been, and then give you a quick sneak peek of where is it that we can go. Now, just as a heads up, we've made it to 50%. We have now reached 100% today, given that this is 100% of the first semester. So we'll get into that. So what is our mission here at the Come Up series? It was simple. Help first. We didn't want anything in return. We didn't ask for anything in return. All we wanted to do was just simply help first. Why is that? Because we believe that essentially, like, the folks in which that do some of the most magnanimous things and that step into our lives, think about the mentors that you've had in your lifetime. Did they ever want anything from you? No, they just wanted you to be great. Think about, your parents. Did they ask anything from you as they were teaching you? No. They just wanted you to ultimately be disciplined and ultimately learn as much as you could so that way you can prepare yourself to create the best future for yourself. And, maybe later on, help them, as they get older. That's just being a good person, I guess. But that's really how we came forth with the mission, is just help first. If you notice, like, for example, when I hold my Instagram lives or when I answer questions, the number one thing that I always ask first is, how can I help? And that's literally what we came forth with, the helping hand. But why? Right? Like, why? Well, simple. We saw a few problems that currently existed. The culture wanted to build wealth, but there was no blueprint. It's kind of like you want to build a house, but you have no drawings, no architectural specs, no nothing. 2, we saw that our movement needed discipline and a strategy, yet nobody gave them. It was interesting. Everybody was talking about, like, success, but nobody was showing people how to become successful. And then 3, we saw that our people needed to understand the purpose and reason to look ahead to write a different future. I mean, sometimes you have to take people out of their existing environment, even if it's just for a small, short period of time, just to get a quick glimpse of just what your life could be, what it could be like. And then once when you've tasted that, then now it's like you have to make the decision of whether or not, like, hey, does this fit? Does this fit? Where is it that you want to be? Or does this current model that currently exists in your life as it exists today, so this current living situation, your current life situation, is that what you currently want? And we just simply ask those questions. And, we formulated some solutions, which were, in this past semester, we taught you 2 solutions. Of course, outside of the other supporting details. But we taught you a few things. We taught you the rolling force, which would give you the discipline. And then we introduced something called the new Roaring 20s, which we gave you a new vision. It's like new sight. Once you see it, we believe that you can't unsee it. And that was the focus. That was literally the focus of the semester. And we hope that we have accomplished that, and for each and every single one of you. And we hope that your portfolios also represent that. So whenever you look at your portfolio, or when you go through your notes, or when you think about the conversations in which that you have, it's the question of, have these 2 solutions that we put forth, have they helped solve those 3 existing problems that we currently saw? And then, I got to give you all a quote. We all have dreams in order to make dreams come into reality. It takes an awful lot of determination, dedication, self-discipline, and effort. This was said once upon a time by one Jesse Owens, who was a world record-setting athlete, who was one of the greatest sprinters of all time, and in some cases ahead of his time, which also inspired me to actually want to become an athlete and run track and field. And so it's just with that kind of understanding that essentially, like, you have to, it's one thing to dream it. It's another thing to literally work at that dream, which is that journey. And a part of that journey, the tools are the determination, the dedication, self-discipline, and the effort. And that's where we built those solutions for each and every single one of you. So today, we're introducing the final half of the 50% of this equation for this semester, because we're going to a whole new level now. So today we introduce to each and every single one of you the walk back. And yes, this is a Come Up series original. We believe that essentially that when we produce things to you, that essentially that they not only inspire you, but they challenge you. They challenge you to think. They challenge you to want to be better. They challenge you to also want to go even further, to learn more and do deep dives into a world that once upon a time seemed foreign, but now is starting to seem a lot more closer. And remember that thing that we, once introduced called that finish line? Remember that in early on where we said that we would show you the finish line? We really hope that we did. Like, for real, we really hope that we did. Because if we did, then essentially we have succeeded. So the finish line, for those in whom which that are new, is where we talked about how to create stellar plays in the market and then reconstruct it to create more. Now, we're going to get into that in a little bit, but the focus here is ultimately, we already showed you the finish line. All we have to do now is just walk it back. So in a part of walking it back, let's get into this other half of that new math, shall we? So in the walk back, we introduce something called 4-3-3. Now, what is 4-3-3? Glad you asked. Well, 4-3-3 is built upon 3 principles. You kind of heard these before, right? You've heard of this thing called liquidity, leverage, and scale. So when we think about liquidity, we think about the game plan and where this is the very, very beginning. This is the game plan when first starting out, you seek less risk, but focus on great rewards. And there's a lot of treasures out there in the market in which that give you that. And then when we think about the next step, the 3, we think about leverage. So you've built the liquidity. Now it's time for a little bit of risk, just a little bit. Now we talked a little bit about like explaining what risk is in our terms. So we just said nothing too crazy. For real, y'all. Don't be crazy here. Now you heard Jolene come out with the goon hand because some of y'all trying to act a little bit rambunctious and act a little bit out of pocket. So we got to reel you back in. Because many of you haven't even started on the first stage, which is liquidity. Many of you just want to come out here and be rock stars and then realize that this rock star life is a little bit too much where the lights are a little bit too bright. And then when those lights are too bright, then ultimately it can come back and hurt you. And we don't want that. We want you to ultimately win. Here at the Come Up series, we produce winners. We only hang with winners. That's what we're all about. When we say that no cousin is left behind, the reason why we say no cousin left behind is because we're going to consistently give you the knowledge and the tools and everything else that transcends beyond time or age, but ultimately allows you to realize that you can buy that time back so that way you can put yourself in a better position and provide yourself a better tomorrow than what currently today looks like. And then once you've successfully done that leverage, then you put yourself in the position as it pertains to scale. Now, when we say this, we say you've managed to successfully complete the liquidity to leverage some of your portfolio, and now it's time to scale. And scale is just a combination of those things. And I'm going to show you what that looks like. But just to break it down for you a little bit further, because I always told you that there was always a gym within a gym within a gym. Well, the first gym was more so in the sense that all 3 of these concepts are built upon the 4 principles in which that my ancestor taught me, which is time, cost, value, worth. It's built upon those key principles. Those 4 principles created the 4-3-3, aka the walk back. I was going to call it the step back, but then I just realized that honestly there was too many basketball players using that move. So I was like, okay, it's time to be 100% original. So let's walk it back a little bit, especially since we've shown you the future. So let's just imagine this for a second. Let's think about businesses, right? To start a business, you need liquidity, aka capital. And without that capital, then ultimately your business is ultimately dead in the water. Unless you just got this magic where it's like you could just literally come forth with an idea and like literally create product and everything else without costing a dime, then kudos to you. But the average business out there needs liquidity. And then once you have the liquidity and it helps you It helps you build some things. You put yourself in a position where it's just like, okay, hey, now I got the liquidity flowing. Now it's time for me to take a little bit more risk, because we like businesses that take a little bit risk, because of the fact that if we don't take any risk, then we won't invest in things that are radical. And if we don't invest in things that are radical, I mean, let's just be real. I mean, we won't have autonomy, self-driving cars, and all these other great ideas that come forth, right? So then that's where leverage comes into play, because now you can leverage a little bit of what you have in order to create something else. And it's going to give you a little bit more risk, but yet at the same token, it can give you a great return, all the while that the liquidity is still doing its thing. And then once when you got that vehicle going, so you got liquidity going, and then you got leverage going, now it's time for you to scale. And this is where we look at, as investors, we look at businesses in which that are able to scale. So not only just do what they do, but also find other arenas in which that not only just like reinvent themselves, but tweak their business so that way it opens up new business, so that way they have multiple sources. If you really want to put it into perspective, think about Apple. Apple started off with one product, and now they sell over 24 products within their entire portfolio lineup. And some of those products that they sell are leverage. Why? Because they're leveraging they're leveraging some of those products to ultimately create new things, like AKA their liquidity is, say, for example, their product lineup of their Apple iPhone, as well as, say, for example, their Macs, which have been around since the beginning, or their MacBooks that have they've been around since the beginning of time. And then they created iPhones from that leverage. The leverage was the iPhone. And then from that iPhone, think about it, that iPhone started to become liquidity. And then that next leverage became, say, for example, their wearables. And then once when they got to that point, now they needed to scale. Now they created this thing called iCloud App Store. Then ultimately a whole array of services were birthed from that. That's where they were able to scale the business. So now it's like you're just looking at the world without time. And now what currently exists for you, your portfolio is finding ways and openings for you in which that it creates much more opportunity, AKA scale. So, if what I just said sounded completely foreign, remember this. A week ago, I presented this, and for those of you that know where this comes from, kudos to you. For those of you that are new, this model comes from one of your favorite ETF companies, ARK. And this is how they see businesses. When you think about it, they have the total market, and then ultimately you have your early adopters. Now, a lot of companies, after they've had their early adopters, many companies will go through this process and fail over time if they haven't been able to get onto the track of the main market. So you start off with some liquidity, and once you've reached a certain amount of critical mass and early adoption, it's now time to go and literally leverage yourself so that way you can join the main market. Now, joining the main market has risks. Why? Because now you've gone from the folks in whom which that are your greatest and biggest cheerleaders, and now they're the folks in whom which that, okay, hey, they're more stubborn and everything else, and there's more risk. Because now that you're on Main Street, now you're completely judged. Okay. But then notice this other, like, normally after a while, the market catches up, the total market catches up. We explain this, but it's really those dope companies. And really, if you think about that company, think about it in the same light as an investor. It's really those dope investors that find ways to literally reinvent and open up a whole new line, a whole new market, a whole new scale, a whole new strategy as it pertains to your investment portfolio. We taught you that. Like, just think about it. You didn't get this from anywhere else. You got it straight here from the Come Up series. And that's the beautiful part about it, because it ties everything in together beautifully. And if you find, like, think about it in the same light that we look at companies that always have early adoption, then essentially it joins main market. Now the rest of the market is ultimately starting to tag along with it. Hey, look at this. Everybody and their mama wants to start an electric vehicle car company. But now it's like, think about it. You're going to see pretty soon, you're going to see the winners separate themselves from the losers, because they know how to scale their business. And then ultimately they'll create new lines of business for them. Sound familiar? So let's get back to it. At 433. Because it's very magical. Think about it like this. 4 plus 3 plus 3 equals 10. Now let's run it back for you, because I may have skipped something, and I held some gems there, and they were hidden in plain sight. Because if you notice, all my gems hide in plain sight. Remember the 4, 3, 3? 4x, 3x, 3x, but we'll get back to that later. 4 plus 3 plus 3 is 10. Think years now, right? Just think years. Take that 10 years times 3 trades. So if you have 3 trades, those 3 trades should, we'll get to it. Those three trades should probably put you on a trajectory towards a 30-year win. Just imagine that. Those 3 trades will put you on a trajectory. Doesn't mean that you're actually going to make it within those 3 trades. I want you to hear me very closely. It doesn't mean that essentially that these 3 trades will put you at a 30-year win. No, they will put you on a trajectory. But here's something funny about that. Because let's take that 10 years times 3. That's 30 years. That's literally 30 years, y'all. Just imagine. Just bear with me for a second. Okay, so I know many of you are like, well, Mark, come on, reel it in for us. Sure. So take your annual salary and multiply that times 30. Don't worry, we'll wait. Just take the annual salary and divide that by 30. So we'll just say for giggles, we'll just take 60K. Is that fair, Jolene?
Sure.
We'll take 60K and multiply that times 30. It's 1.8. Now you ready to see some magic? Because many folks want to talk about, like, hey, I want to leave. Where is it that I currently work and all this other stuff? Do I have to make the 1.8? So then take that salary, that annual salary that you multiplied times 30, and then we're going to divide that, remember, by 10. Just by 10. So that 1.8 divided by 10. That's 180K. 180K. Now, hold on. Don't worry, Jolene. Don't worry. We're gonna, I want people to understand something here. Let's take, for example, the person that has, let's say if you had $5,000 to invest, right? You have $5,000 to invest. And we're going to say that we're going to do the 4-3-3, because if you really look at the 4-3-3, it's 4x, 3x, 3x. So you're going to take the 5,000 times 4 times 3 times 3. $180K. You can walk away. You can walk away. Can you believe it?
Yeah.
So let's discuss this, because I know that there's going to be questions. So let's discuss it.
Yes. All right. So
you're muted. I can't hear you, Jolene.
Oh, no, I'm not muted. Can you hear me? Can you hear me? I'm not muted.
I can't hear you.
Can you hear me now?
No, you probably have to adjust your audio settings or use your Bluetooth headphones. So while Jolene's getting her audio together, so think about it. The 4 times 3 times 3. So that's 10x. 4x, 3x, 3x, that's 10x. That's the type of stuff where, well, they're saying that you can, okay. So that's maybe me, because I was doing all this time. My bad, Jolene, my bad.
Dang, Holly.
Well, wait, then the whole time, could you guys hear me?
Yeah, we could hear you, but you turn your volume down.
Oh no, my soundbar just went off.
Oh, okay. Got it.
So really, when you put it into perspective, that's literally a 10x return. The 10x return is literally the equivalent of, say, for example, a 30-year return.
The city boys, for the record, can hear me.
Wow.
That was hot off the press. Okay, so let's back it up because I know what the cousins are thinking right now. So now let's go. Let's start from the very beginning and
Okay.
walk it back with. Let's take that $5,000. Let's put it in the context of the rolling four, or like let's use some real numbers and walk it back.
Well, it's funny because remember that whole thing that we had to actually let's go back to that original one. Like we're gonna like even take it even further into a beautiful study hall, shall we?
Yeah, we should.
So let's go back all the way. I'm glad that you said that. Let's go all the way back to the rolling fours because I think that that's really crucial.
It is.
So if we think about it, let's see here. Remember that little section where we were talking about, like, for example, if you did the rolling fours and everything else.
Mm-hmm.
But remember there was that section that was on the left side that had nothing to do with the rolling fours capital?
Yeah, that's what I want you to talk about because I want the cousins to really understand what this new math is all about.
Right. So I'm going to go back to that slide because
Hey.
honestly, that kind of like went over everybody's, I'm probably sure that they went over everybody's head where they didn't see that. So in this example back, and now mind you, this is a while back, we said that if you started off with 50K and your first return was 5X, and then essentially your second return was 1.5X, that puts you at 1.87. Now, of course, you had the other capital running at the same time when you were making those contributions while you were working. So let's say that if you had your initial capital, but then essentially from there, you had your rolling fours capital. You had them both split, operating separately. They were working in their own corners. Now, your rolling fours capital should be the capital that ultimately puts you through and propels you over the next set of time to come. And then essentially the initial investment capital. Well, I mean, that's honestly what you can do to just imagine what you could do with it. You can build cities. You can do whatever that you want with it.
Mark, let me say something.
Yeah.
So the cousins really understand it. So let's say that you have your initial investment. Think of your initial investment as the portfolio where you do not contribute to any further. You
That is
just have
correct.
that one-time initial investment and you continue to trade like you put in the rolling fours, but you do not add money to it. But when you're looking at the rolling fours, that's something that you consistently add over a quarterly basis, for instance. So
Correct.
just keep those two things in mind. They're essentially, it's like two strategies deploying at the same time.
And it's funny because here's the funny thing. The walk back was sitting there the entire time on the rolling fours strategy. It was hiding right there in plain sight. Crazy, right?
It is. Okay, so now that they understand there are two different strategies, you got your initial investment. That might be the $5,000 that you don't contribute to again. That's just that one-time initial investment. Then you have your rolling four strategy and whatever amount that is. I think the example was 100K and we divided that by 4, so 17.5
every quarter.
Every quarter. Okay, so those are two things. Now roll it back to when you did that $5,000 for that initial investment with no further contribution, and you put it into the new Roaring 20 strategy.
So now I have to do the Roaring 20s one.
Yeah, I want these cousins to see this.
Yo, she's trying to make me walk all the way back, y'all.
Walk it back, y'all. Walk it back.
Oh my gosh. Okay. So if we go to that one, I'm gonna have to close this one because I guess I get it. It's
did you have more to say about the other one before you close it?
No.
Okay. I just want to make sure folks get it. You know what I mean?
Yep. So remember back when we said, the formula of the walkaway money divided by annual salary equals years of freedom?
Yes.
Because we said, what is your freedom cost?
Mm-hmm.
And then we said, okay, hey, remember that generational thing? You divide that by 20 years. The roaring 20s is ultimately what you do. So here, let's put it all into perspective.
Yes.
The walk back capital is what you started with. The roaring 20s is what you started building over a 3-year time. So technically you're building two portfolios at the same time. Then when you've reached a certain point with the rolling fours, then essentially from there, now you take what you've gained over that 3-year or 4-year spectrum. And then you take that when your portfolio is done, then you can divide that by 20, and then you can see the generational wealth that you created. Meanwhile, the initial investment that was existent on the left side, which is the walk back, that essentially allows you to walk away from, say, for example, that 9 to 5.
So are you guys getting that? So there is your walk away, which is, W-2 who are you talking to? You ain't talking to me. So there's that, which is your initial investment that you don't recontribute to. And then your rolling forward strategy, AKA the roaring 20s, that's what you're building your generational wealth on. And so it's really important to see those two as distinct, but at the same time, both working in tandem to reach your actual final goal. Because many people think you need $80 jillion to walk away, and you don't. Like once you put the 70-30 down, meaning that you invest 70% and you only spend for your expenses 30%. Once you get that down, your expenses are down. You've built up your wealth consciousness. So now you don't need as much as you think you need, because you are so excited to invest that all of a sudden you don't need that latte or venti whatever from Starbucks. Shout out to Q. So so just think about the power of that, like what's happening. That's why it's really important to think about like what your walkaway number is. Like, what are your expenses? Like, what would it take for you to, be able to do all the things you want to do, but at the same time also continue to build wealth? Because we got people that are taking out withdrawals of their account, like they think they are investing for something, and then they drain the account, and then they got to start from scratch. That's not the way to do it. You got to be
can I help there? Can I help there?
Yes, yeah.
So let's put this into perspective, shall we? When we talk about this walk back. So with the walk back, let's put it into perspective. So when I said that, if you think about it, remember that if you had the 180 and then you multiply that times 10, then that puts you at 1.8 million, right? Yeah. And of course, it's like if you're waiting for 1.8 million to walk away, it's just like, well, what's the point? I mean, you could pretty much walk away. But just imagine this, if say, for example, you paid yourself out of the 60K that you make a year, you paid yourself to 30K. So then that leaves your account with, what is that, 150K?
Mm-hmm.
From the 150K, you should be able to rebuild and literally to replace the 30K that you've already paid yourself. So that 150K and that entire process, for example, the 150K, if you put a multiplier of 300%, and that puts you at 450K. Take away again, say for example, another 30K. Or if we want to just do it by year, let's just do it by year, just to keep it simple for everybody. Take 100K minus $60,000 from that person. That's 120K. Times 3, which is a 3-time multiplier. I'm playing at pretty much the very base case number, because I would rather weather a person's expectations. I'm a huge fan of under promise and try to over deliver. I'm a huge fan of that. So then that puts you at 360. Okay. Again, year 2 minus 60K leaves you with 300 times 3, 900K. So really you're in a position where essentially you could pay yourself and then literally live off of what is it that you make. If you've been able to figure out a way to literally keep minimizing your expenses, then you'll need less and less and less. And then essentially you'll just keep accumulating more.
Okay, so we got some cousins that are in the comments that are confused. They probably need a visual. So I say to you to will obviously watch this video again, and then watch the videos that are in the starter pack, but then also focus on your whatever your initial investment is and get yourself prepared to the point where you're living 70-30. And then once you have that down, then start implementing your rolling fours. Because sometimes you're not ready to implement your rolling fours yet, and that's okay. So I'm glad Mark brought the calculator up.
Yep.
So
So
yeah.
So let's start off with, let's remember that 5,000 that we're going to start off with. So we're going to start off with $5,000. Person X has $5,000. Now, what did they do? Times 4, times 4, times 4, or whoa. 5,000 times, say for example, come on, Mark. 5,000 times 4 times 3 times 3.
Wait, so the 4 you're referring to is the quarter, right?
4 represents the 4x return that you got from that initial investment. The 3x represents the second investment that you made that equals a 3x. The third is the third investment, which is another 3x investment. So really that's 400 percentage return, 300 percentage return, 300 percentage return. That's literally it. Okay. So then let's say that the person makes $60,000 a year. All right. I pay myself $60,000 for that year. That leaves me with $120,000.
That is currently in your portfolio. It's not in your bank account.
Correct. Well, now that becomes a part of your bank account. You just live off of that.
The 60 is what's in your bank account, essentially.
Correct. Okay. So then you take that 120 that's still in your investment, and then you focus on just a simple 3x return. So the
$120,000 that is left over from that $180,000. So you're living off $60,000 in the year. You leave 120 in your portfolio, in your market portfolio. And then if you have a return of, what was that?
3x.
Yeah. So if you have a 300% return, your money is working for you. Your money went to work and it brought back $360,000 while you're still living off of your $60,000.
Correct.
Okay. Just want to make sure the cousins get that part. Okay.
But then person pays themselves again $60,000.
Right.
300K.
In your portfolio, people.
But the 60K is taken out so that way ultimately you can pay yourself.
Yes. Okay.
So then from there, times 3x return.
Now you are $100,000 away from $1 million, but yet you are still living off your $60,000 a year because you have your 70-30 down. And by now, maybe it's even 80-20 or 90-10. It just depends on how you're trying to do it.
Okay. Mm-hmm. Now remember, what year are we at now? So we did 120, 360, 900, right? Mm-hmm. So really we went from 120 to 360, 360 to, really at the end it was 120 to, what is that, 360? 360 minus 60 is 300 to 900,000.
So is that 3 years?
Yep.
4. Okay. So 3 years, y'all, with $5,000. Mm-hmm. In 3 years, that is $900,000, and you are living.
This is without any extra contributions, by the way.
Right. So you have essentially made it so that you can walk away from your job. You don't need a W-2 at this point.
Correct. So that
then $5,000. I really want you to understand that.
But check this out, peep game. Mm-hmm. They take away 60K. They take away 60K.
Okay.
840,000.
Yep.
Times 3.
So now, because you have humbled thyself and you have lived off of your $60,000 for, now we're on 4 years, you now have $2.5 million, and that is with below average return of 300%. Average for options is 500% to 750%. So like Mark said, we're being conservative here. So just being conservative is $2.5 million in the bank in your market portfolio that is still working for you while you are living your best life with 60. Because you're not trying to flash, you're not trying to, keep up with the Joneses and them.
So the first investment for anybody that needed to understand is you start off with simple 5,000.
Right. And also, consult your tax professional.
Of course. I mean, to keep in mind, if you're doing this through an IRA, it's like the beautiful part is that you just paid. It's like you just literally just paid. Here's the cool part: if even if you just contributed like pretty much the 6K max, I think it is 6K max a year, that could be the equivalent. If like the very worst case, you can literally start this off with the 6K. Of course, reorganize these numbers, and then do it again the very next year to start your next set while your other one's already cooking. 12K each year literally puts you in, say for example, an even higher tax bracket. It's just a matter of, again, do you take the discipline and do you carry the vision?
Yes, discipline and vision. And then one other thing, because I know cousins are going to ask about this, the type of account that you're working with. So you want to obviously consult a tax professional.
Correct.
That's not us. So you want to ask that tax professional what is the best the best account type to place the money in, and let them know what you plan on doing. Let them know you're like, okay, so I want this to work for me. This is going to be my first initial contribution. I'm not going to contribute any more to this. And then what I would like to do is get it to a point where I'm able to withdraw, X amount every year, or however you're going to do it. And then that tax professional will be able to tell you what type of account it should be. Some of y'all will have 401ks, and after you leave a job or whatever, and you can't contribute any more to it anyway. So then that's a good portfolio to use for this particular type of investing. Now, granted, if it's a traditional like rollover, you will have to pay that 10% penalty, and then you'll also have to pay taxes. So again, consult your tax professional. We're really just trying to keep the math simple so that you can like catch the vision of it, and you can work out all of those nitty-gritty details with your tax professional.
I mean, the reason why I wanted to say this, and I felt like it was very fitting because I've been getting messages about people like, trying to do all these risky trades and everything else. You don't have to. Like, that's the point. You don't have to. Like, when we showed you the finish line, if you didn't realize what the finish line was the fact that it was like all this didn't really require, like the only part that was the hard part was just the study part, just to understand exactly what the market is and how does it operate and who the companies are. Outside of that, it was like, okay, well, in the first semester, literally you got to see what the finish line looked like.
Exactly. And then what's even better,
and you saw how easy the finish line was.
I'm saying, right? And then as many times as, I don't know how many times I've said it, but as many times I said, let no thing stop you. It was more so like, you don't get in the way. Like, it's already laid out there for you. And like, honestly, even if you did not do not one lick of research, you could tell on yourself if you want to. But if you didn't do any research and you just went with the 31 sips and, got in the strike price and you just left it at that, like, okay, but I'm glad that you all are scholars and you studied anyway, because then you'll be able to teach that to others around you. So that's the real wealth right there, being able to share this and set more and more people on this trajectory for freedom. And then also being able to be a part of the No Cousin Left Behind. Because if everybody is on the same vibe of No Cousin Left Behind, you're going to reach back. You're going to keep reaching back and, forming your study groups and learning these formulas and answering questions of new cousins coming in. So like the way it's all, set up, like Mark said, it's the wind's there.
Simple. Like, a lot of folks wonder, like, well, Mark, why is it that you don't play weeklies, or why is it that you don't play monthlies? Because I don't have to. Like, the wins that I've already baked in, I already take the guessing out of the way.
Now y'all know why I'm the first lady of leisure, because Mark taught me all this and I have been leisurely ever since. Okay. Like, I'm not the kind I'm not going to be that person that's, on 80 jillion webinars teaching you how to do. That's not me. I am leisurely. Okay. Like, if you are stressing me out, even through a DM, bye. I'm on my leisurely, you know? So not that hasn't happened though. I'm just saying if it did. But you don't have to be, this who is someone I mean, you don't have to be like all deep in it, 24/7. To me, it's fun. So that's why I make rituals out of it because it's fun. But like if it's already set up and all you have to do is set up your account, put your money in, pick a trade, let it cook, be disciplined, read about what your money's doing, obviously. Have some conversation with some cousins, tell some other cousins about it, and just you can change your entire life. Your entire life.
I mean,
Like, I'm so serious.
can I put it into perspective for folks in whom which they
Yeah.
like are struggling to realize it? Your average stock grows at, say, for example, 15 to 20% year over year. You play that correctly over, say, for example, you do a 2 year, and then essentially you could really play the 1 year price target or the 1.25 price target into a 2 year trade. That's an easy 300%. That's a very easy 300%. Like I said, it's not that hard to be right. It really isn't. It's just a matter of just doing the simple studying of learning who the company is, what is it that they do, how are they doing, and then really putting it into context as it pertains to what all those things that what will be for them in the future. You can kind of get a good glimpse, like, for example, when we talked about CES, when we talked about some of those companies, like, for example, maybe, people were sending me text messages talking about, like, Mark, you've been talking so bad about the CEO of Intel that he decided to step down. I didn't. It's just that the investors realized that essentially that he wasn't going to be the guy to carry them over. So they had no scale plan. They had the liquidity. They had some of the leverage because they have all this tech, but they had no scale plan. And that's the reason why they've been getting their butts kicked by AMD and NVIDIA. I mean, when you put it into perspective, like when you look at all the other car companies out there, the reason why they're not doing as well, they got the liquidity. They got a little bit of leverage because they can mass produce, but they don't have the scale, because of the fact is, if they had the scale, they'd be beating Tesla. It's not rocket science, though. That there is going to be a rocket science ETF that's going to be hitting the market, and congratulations to those that are interested. But it's just in the sense of like, just be a studier, become a scholar of the world around you, be a scholar of, say, for example, industry. You become a scholar of industry, then ultimately everything around you opens up, and it's like the world not only looks brighter, but essentially you start to see sometimes time slows down. You can see time slow down where, like, for example, when we showed you the finish line, we showed you what it was like to be walking through a world without time. Why? Because you're walking backwards. It'd be different if you had to start all the way from the beginning and then learn all these things like candlesticks and all these other things, and then deal with some of these folks in which they put you into weeklies, dailies, and all this other stuff. I mean, that's fair. I mean, but we didn't do that. We just showed you, hey, that this is what it looks like to be in a winning strategy, and then ultimately not even have to worry about it, not even have to consistently check on something. Like, if you really wanted to, you don't even have to check your portfolio every day anymore. You can check it on the end of the week. You can check it, say, for example, on a monthly, though that I would probably say it's a mixture between those, just to check in and see how the market's doing, and also to continuously be a scholar of the market. But honestly, when you pick great plays, when you pick great companies, then honestly, the work, honestly, it's no longer really work anymore. Like, that's the point.
Yeah. I mean, honestly, Mark, this type of investing is so on brand for me personally.
I try.
It really is, because I'm telling you guys, it is a whole vibe when I am just in my little silk robe with my hot beverage, usually coffee, and I'm on my iPad Pro scrolling through the news like, oh, interesting. Looks like I'm going to be balling today. Nice. Oh, what's AMD doing? Oh, what's Tesla doing? You know what I mean? Like, it's so leisurely. There's no physical labor. Like, Yo, this is not
Which
meant
one
to
would you
be.
rather have? Which one would you rather have? Working at a place in which that honestly is like you could probably develop carpal tunnel, arthritis, or say, for example, other ailments.
Hypertension.
Or say, for example, just use your brain and ultimately make money.
Yo, but
To me, when I learned that valuable lesson early on in my life, it was like, yo, it became a lot easier. Now, the things in which that I had the opportunity and privilege to work on is because of the fact that I wanted to do those things, because of the fact that I prepared myself so that way I could. Like that's the main thing for everybody to say. Like, hey, Mark, you worked at a job. Yeah, I did. But yet at the same token, I chose where I wanted to work. Like I got to help start an engineering firm and help make it successful. I didn't just go work for anybody. I worked underneath my mentor, in whom which that I enjoyed being around. It didn't even always feel like work. It felt like something that I was learning. Like it's a difference. Like for those in whom which that still want to continue to keep working, that's fine.
Yeah.
You do that. The thing is, what good is it knowing that essentially that, okay, hey, if you're let go, then now you have to go through the process of finding another job, or knowing that you're working, but knowing at the back end, hey, at any point in time, I can leave and do whatever it is that I want. And nobody can tell me what I can and what I can't do.
Exactly. For me, Mark, personally, it's the freedom to create whatever it is that I want to and not have to worry about, oh my gosh, I have to, sell this painting or whatever to make ends meet. No, like if I create something and if I happen to offer it for sale, like cool, but I don't have to. And that is really the beauty of it. I can just create for the sake of creating.
Yep.
Like to me, that is just the bee's knees.
I just wake up every morning and consult myself in the mirror and say, what is it that I want to do?
Like that's it.
Like that to me, there's no greater freedom than for me to say, hey, that this is what I want to do today, or this is what I want to execute today, and boom, I'm gonna go do it. If I don't feel like it, I'll just stay in the bed and just watch the theater take place on TV.
What's even more lit is that this is accessible to everybody. Now, Mark, one thing I know we're a little past the hour, but
that's fair.
I would love if you would bring up the calculator again and do it with $1,000, because there are a lot of cousins that are starting off with $1,000, and I would just want them to see what's possible.
Okay, I mean the rules still apply, but if you started off, hopefully everybody can see this. Can they see it?
Yes.
So if you started off with $1,000, well, times 4, times 3, times 3, 36. And if you still can't walk away, times 3, times 3, times 3.
How many years? 5? Okay.
6 years. 6 years.
Okay. So even that, like, yo. And that's without taking anything out. So
but I will say this when you're dealing with a 1K investment. Honestly, I'm not the type of person that just sells people with false hope or false dreams. I would say, to really kind of execute this strategy, it really will start off with probably about 2,500. And then times 4, times 3, times 3, 90K, times 3, times 3, times 3.
How many years is that?
That's 6. That's the same 6.
Okay.
You want to know something funny? You want to know something, but you want to know something funny about that 2,500 though, Jolene?
What?
You want to know something funny about all those numbers?
What?
Remember when you and I first met? That was the exact same number that I showed you. That N number is exactly what I showed you, and I started from 2,500.
Okay. So yo, there it is. Okay, so just to clarify, because I just saw this in the comments, the 4, when you see the 4s and the 3s, those are the percentage return. So the 4 would be equivalent to 400% return. So the 3 would be 300% return, because people are like, what's the 4? What's the 3? That's what that is.
Yeah.
Yeah. So you can take any number that you're starting off with, obviously the more the merrier, obviously, but it can be done with, a modest amount.
I'm like, I mean, at that point, it's like, what else can be done?
Right. And then don't really get all into it, or I mean do, but at the same time, like, yo, if you have that one what is it, the stimulus check, and you had $1,200 or however much they're gonna give people, $1,200, and you flip that, and then all of a sudden something else happens. Maybe you get a bonus or a tax return or like whatever, and you can start that process again and again and again and again and again, or contribute it to that account. But those were examples when you don't contribute anymore.
Yeah.
But you could
But you would want to. I mean, you would
yeah.
ultimately want to. It's like the focus is that, when we think about it in perspective, simple perspective, you got to get to a place in which that honestly, these numbers are great, but yet at the same token, it's like, what good is having all this wealth if you don't know how to keep it, or if you don't know how to manage it, and if you don't know how to steady and stay your hand? Like a lot of folks want, like, a lot of folks want to sit on the throne, but they don't understand the weight of what it costs in order to sit there. They don't. They want to wear the crown of wealth, but they don't want to wear the responsibility that also comes with having that crown of wealth. That's the lesson there. That's the key there. It's not only just in the sense of building this wealth, but it's also in the sense of, can you also develop discipline? Because if you notice, like, think about all the folks out there that are wealthy. They're not out there buying, like, a few of them, they're out there buying cars that ultimately, in which that, that they collect and that they can use to, like, say, for example, leverage and like become a part of a collector's and then let it appreciate over time. That's fair. But to the, honestly, they're not out there, like, and to put it into perspective, we live in Seattle, where there are probably the most amount of millionaires per capita that walk around us, in which that you would never know. And why is that? Because honestly, they're not sitting out there trying to like buy up the newest thing or do all this other stuff. They're just living simply.
Mark, did I tell you about that time that I was, at the Magic Johnson Starbucks on 23rd and Union? I don't think it's his anymore, but the real jazz one.
Yep.
Okay, so I was in Starbucks with my grand mentor, and she told me, she's like, look around. This is one of the only Starbucks in Seattle where the majority of the patrons are Black.
Yep.
So she told me to look around. First of all, the Starbucks was filled with nothing but men. And what was interesting is that there was like this change of guard. You saw, a certain subset of Black men that came in. They all knew each other, hey,
Yep.
brother, all that. And then that group left. And then another group came in, and this was the group that, the majority of them were
just hung around.
Yeah, well, a majority of them were immigrants. So there's talking, laughing, all that. And we sat there and watched, and she was pointing out all the ones that were multimillionaires. She was like, that one over there owns such and such and such and such on 51st Street or whatever. She's like, and then this one owns this one. And when I tell you, they were just average looking, in sweats, beat up kicks, not even fresh kicks, beat up kicks. Okay. You would never know. And they were just going in there to get a little latte or a little cup of coffee, say what's up to their people, and go on about their day. And they own so many different things. So
it's funny. Like, I'll give an even better example. When we think about billionaires, think about Jeff Bezos. When Jeff Bezos had reached the billionaire club, and because Amazon was taking off, interesting thing, he was being interviewed by a guy who was literally asking him about, like, hey, like, your wealth and all this other stuff. You're a billionaire. Why are you driving around in this old Honda that's dusty? And Jeff Bezos didn't even respond at first. It was an old 90s Honda that he was driving around in. And then he was like, did you hear my question? He was like, yeah, I heard you. And he was like, and I think Jeff Bezos was offended. And he was offended because he was like, it's a good car. It still runs. It still gets me from point A to point Z. It's very efficient and everything else. Why do I need? And it's because of the fact that Jeff Bezos, like, he didn't look like a billionaire. Like, what is a billionaire supposed to look like? What is a millionaire supposed to look like? We don't know. I mean, it's not like, where they were coming up with the definition of millionaire and billionaire, that they said, okay, hey, well, these are the characteristics of what they should look like. That's each and every single one of you as it pertains to, hey, it's possible.
Right. And also, don't let somebody else spend your money. Don't let someone else tell you what you should be spending your money on.
No.
Like, oh, why don't you have a new car? Or, oh, why don't you? No.
Like,
no.
I don't buy an 18-room house because, honestly, one, I'd feel overwhelmed in having to furnish it and then keep it clean and keep it dusted, first of all. And two, it's like, what's the point? I'm only one person. It's like, I don't need to have all these rooms. Like, we need to get past this mindset where it's just like, we don't need to buy all this frivolous, stupid stuff that ultimately just represents greed and excess in order to, like, show off to the rest of the world that says that, okay, hey, that we're doing okay. I mean, now, if that's your speed, then by all means, no shade towards you, no knock towards you. But I'm just saying that we got to get past this mindset of this whole MTV Cribs culture, where it's just like, okay, hey, in order for you to be where you're at, then honestly, then this is what you must look like. That's not true. And that's one of the main things in which that, honestly, we're holding ourselves back with that type of dated and, misunfortunate and ignorant mindset.
Mm-hmm. Well, that was the semester, Mark.
That was the semester. Well, I mean, we come back next week and a whole new semester begins, and this should be interesting. But hopefully each and every single one of you have been able to grab some significant value, because we definitely went over time.
Mm-hmm.
But we hope that you grab value and everything else from this show. I mean, if anything, if you've ever learned anything from us, like, the biggest lesson that you can take away from today's session is that you can do it.
Yeah.
Simply, like, with a simple can-do attitude and a spirit of that, hey, that might come up as right on the horizon.
Mm-hmm.
And the fact that, honestly, it's like, yo, hey, you got people that are rooting for you. That's all that you really need. Now it's just a matter of just getting to a place where you can just focus and just execute. That's it.
That's all she wrote.
Jolene, you got any last words for us?
No, man, I said my piece.
Like I said, I told y'all that this episode, I said what I said, and then ultimately, it was said. So thank y'all for watching today's episode. Hopefully you grabbed some significant value from today. If you liked the video, go ahead and smash that like button. If you didn't like the video, that's okay. Go ahead and hit the dislike button. But please tell us why. You can hit us up in the comments to let us know how we can get better. Until next time, I'm Mark Monroe.
And I'm Dylan GC in a place called Free.
And this was your come up. We'll see you next Tuesday. And at the same token, I'll be on Clubhouse on Saturday with a special fireside chat with Mr. Gary Gilliam from the Bridge Project. See you on the next one. Peace.